Inflation hits record high, interest rates rise again, markets react to Fed statement.
The alarm blinks 6 a.m. Before your feet touch the floor, the world is already speaking to you in a language of numbers. The clock radio hums to life, and a calm, authoritative voice cuts through the early morning quiet. Inflation numbers came in slightly hotter than expected, at 3.1%, it says. Another voice follows. The central bank is now widely expected to hold interest rates steady at its next meeting. You hear snippets about mortgage applications, car sales, and the stock market's opening bell. These are not just random news items. They are the echoes of decisions made in quiet, serious boardrooms by people most of us will never meet. They are the results of a force that shapes the world around us, an invisible hand guiding the flow of money itself. This force is called monetary policy. It is a powerful, often misunderstood part of our modern lives. It influences the cost of the home you dream of buying, the availability of the job you hope to get, and the price of the groceries you put in your cart each week. It operates in the background, a constant hum beneath the noise of our daily routines. The headlines we hear each morning are merely the surface ripples of its deep and steady current. This system determines whether the economic weather will be sunny, stormy, or something in between. It is the architecture of our financial world, and its blueprints are redrawn with every new piece of data, every speech, and every decision. Its name is monetary policy, the invisible hand that moves the modern world. At its heart, monetary policy is the management of a country's money supply. It is the job of a special institution called a central bank. Think of a country's economy as a large, complex house. The central bank acts as the house's thermostat. Its primary job is to keep the economic temperature just right, not too hot and not too cold. If the economy gets too hot, prices can rise too quickly. Inflation, like the house becoming uncomfortably warm. If the economy gets too cold, growth can slow, and people can lose jobs, like the house becoming chilly and damp. The central bank adjusts the controls to maintain a comfortable, stable environment for everyone inside. These institutions go by different names around the world. United States, the Federal Reserve, the Fed. Eurozone, the European Central Bank, ECB. United Kingdom, the Bank of England. Japan, the Bank of Japan. While structures differ, their fundamental purpose is the same: guardian of the currency and financial system. They are designed to be independent of day-to-day politics, allowing them to make difficult long-term decisions. Central banks generally have a few key objectives. First, price stability. Keep inflation low and predictable. Most aim for around 2% per year. A little inflation is healthy. It encourages people to spend and invest rather than hoard cash. Second, maximum employment. Set conditions so everyone who wants a job can find one. Keep unemployment low without triggering excessive inflation. These two goals can conflict, a delicate balancing act. Third, financial stability. Make sure banks are sound and credit flows smoothly. To manage the economy, central banks use a few primary tools: interest rates, quantitative easing, reserve requirements. The most well-known and powerful is the policy interest rate. This is the rate at which commercial banks can borrow money from the central bank overnight. This single rate acts as a benchmark that influences all other interest rates in the economy. Mortgages, car loans, credit cards, business loans. When the central bank wants to stimulate the economy, it lowers this rate. This makes borrowing cheaper. Businesses take out loans, spend more money, invest in new projects. This in turn can create jobs, boost economic growth. Conversely, when the central bank is worried about the economy overheating and inflation rising too quickly, it will raise the policy interest rate. This makes borrowing more expensive. Buy homes on credit, buy cars on credit. Businesses postpone expansion. This slowdown in spending helps to cool the economy down. Bring inflation back under control. Think of the interest rate as the economy's primary gas pedal and brake. A small adjustment by the central bank can have a ripple effect, changing the speed of economic activity across the entire country. It is a blunt instrument, but a very effective one. A second tool, famous after the 2008 financial crisis, is quantitative easing, or QE. QE is used when lowering interest rates to zero isn't enough. In QE, the central bank creates new digital money. It uses that money to buy financial assets, usually government bonds from commercial banks. This action has two main effects. First, it injects a large amount of cash into the banking system, giving banks more to lend. Second, by buying bonds, it raises bond prices and lowers long-term interest rates. Cheaper borrowing for government. The story of modern monetary policy is a story of evolution crises innovations. The creation of the U.S. Federal Reserve in 1913 established to prevent frequent banking panics, acting as a central authority for financial stability. The 1930s showed the dangers of getting policy wrong. During the Great Depression, tight monetary policy deepened and prolonged the downturn, teaching the importance of providing liquidity during a crisis. Inaction could be just as damaging as the wrong action. After World War II, a new international system emerged. At Bretton Woods in 1944, countries agreed to link currencies to the US dollar, and the dollar was convertible to gold at $35 an ounce. This created relative stability, the gold standard era. By the late 1960s, the system strained. The US was printing more dollars to fund the Vietnam War and domestic programs than gold reserves could back. In 1971, President Nixon ended dollar-gold convertibility. Monetary policy might sound abstract, but its effects are felt directly at your kitchen table. One of the most significant ways it touches your life is through the cost of borrowing money for a home. When the central bank lowers interest rates, mortgage rates tend to follow. This means your monthly payment on a new home loan will be lower, making homeownership more affordable for more people. This can drive up demand for houses and consequently increase their prices. Conversely, when the central bank raises interest rates to fight inflation, mortgage rates climb. Your potential monthly payment goes up, which can price many people out of the market and cause home prices to cool off or even fall. The same principle applies to many other areas of your life. The interest rate on a car loan, a student loan, or your credit card balance is all influenced by the central bank's policy rate, are all part of the kitchen table effect of monetary policy. Section 6. The hidden costs, bubbles, imbalances, and fragile growth. While the tools of monetary policy are essential, they have side effects and hidden costs. One big risk of rates too low for too long is asset bubbles. Cheap borrowing encourages excessive risk-taking and speculation. Money flows into assets like stocks, real estate, exotic investments. Prices get pushed far above fundamentals, creating a bubble. Bubbles always pop. When they do, prices crash and wealth is wiped out. Banks and financial firms can fail. Recessions often follow. Think the 2008 crisis preceded by a massive housing bubble. Cheap credit can also create imbalances and fragile growth. Growth based on rising asset prices and easy credit is unhealthy. Sustainable growth comes from innovation, increased productivity, investment in new technologies and skills. Borrowing to buy existing assets creates a hollow economy. When credit tightens, growth can vanish fast, revealing the weaknesses hidden by easy money. Prolonged low rates can create zombie companies. Section 7. Two hands on the wheel, monetary versus fiscal policy. To steer the economy, there are two main sets of controls. We have already discussed monetary policy, which is managed by an independent central bank. The other is fiscal policy, which is controlled by the government. Fiscal policy involves the government's decisions on spending taxation. If the government wants to stimulate the economy, it can increase its spending on things like infrastructure, healthcare, defense, or it can cut taxes to leave more money in the pockets of people and businesses. This is known as expansionary fiscal policy. It directly injects demand into the economy. On the other hand, if the government is worried about rising debt or wants to cool down an overheating economy, it can cut its spending or raise taxes. This is known as contractionary fiscal policy. Unlike monetary policy, which works indirectly by influencing borrowing costs and financial conditions, fiscal policy has a more direct impact on the economy. Ideally, monetary and fiscal policy should work together in harmony. Section 9. The digital horizon, the future of money and control. The very nature of money is on the cusp of a profound transformation, and this will inevitably change the future of monetary policy. Central banks around the world are actively researching and developing central bank digital currencies, or CBDCs. A CBDC would be a digital version of a country's physical cash, issued and backed directly by the central bank. Unlike the electronic money in your bank account today, which is a liability of a commercial bank, a CBDC would be a direct claim on the central bank itself, making it the safest form of digital money. This could allow for incredibly fast and efficient payments, and could enable the government to send stimulus or relief funds directly to citizens' digital wallets in a crisis. However, this new technology also comes with significant risks and questions about privacy and control. A CBDC could potentially allow the central bank and the government to see every transaction a person makes. This raises major privacy concerns. Furthermore, it could give policymakers powerful new tools. They could implement deeply negative interest rates to force people to spend money during a downturn, or even program money so that it could only be spent on certain things or would expire after a certain date. While these tools could be used for good, they also represent a dramatic increase in state control over individual economic life, a prospect that many find deeply unsettling. Alongside digital currencies, the rise of artificial intelligence and big data is also set to revolutionize monetary policy. The future will require finding a balance between leveraging these powerful new technologies and preserving the human judgment and wisdom that are essential for navigating an uncertain world.